Hello and welcome back. In this video we will work on a case study related to Acme Corporation. We will learn how to prepare a cash flow statement under both the direct and indirect method using information that can be found on the income statement and the balance sheet. To prepare the cash flow statement of Acme Corporation under the direct method, we need to calculate the following amounts: cash received from customers, cash paid to suppliers, cash paid to employees, cash paid for other operating expenses, cash paid for interest, cash paid for income taxes, cash received from the sale of equipment, cash paid for the purchase of equipment, cash paid for long-term debt, cash paid to repurchase common stock, and dividends paid. To calculate all of those amounts, we are going to need an income statement and a balance sheet of 2 consecutive years. The income statement of Acme Corporation for the year ended 31st December 2018 is shown on this slide. We start from revenue, which is equal to $23,598, and we end up with a net income of $2,210. On this slide, we see the asset side of the balance sheet of Acme Corporation for the years 2018 and 2017. And the change in the asset amounts between the years 2018 and 2017 is also reported. And on this slide, we see the liability and equity side of the balance sheet of Acme Corporation for the years 2018 and 17. And again, the change in the liabilities and equity is also reported between these 2 years. We are also given some important information at the bottom of this slide. During 2018, Acme purchased new equipment for a total cost of $1,300, and no items impacted retained earnings other than net income and dividends. We are going to need this information when preparing the cash flow statement. Let's start with the operating section of the cash flow statement, and we will prepare it first using the direct method. To prepare the operating section of the cash flow statement, we need to report all the cash receipts and disbursements related to the day-to-day activities of the firm. We can start with the cash collections from customers. The income statement of Acme reported revenue $23,598 for the year ended 31st December 2018. The change in accounts receivables, which can be calculated from the 2 balance sheets, is 55. So how can we calculate the cash collections from customers? Revenues is a mixture of cash collections and cash owed by the customers. So we need to remove from revenues the non-cash component. So we are going to subtract from revenues the increase in accounts receivables, the amount that the customers owe to us. So we are going to have $23,598 minus 55. And this gives $23,543 cash received from customers. To calculate the cash paid to suppliers, our starting point is the cost of goods sold obtained from the income statement, and we also need the change in inventory and the change in accounts payables, both of which can be obtained from the 2 balance sheets. So we start with cost of goods sold equal to $11,456. We add to that the increase in inventory, which is equal to $707, to find the total purchases from the suppliers in the year, and this is equal to $12,163. The purchases is the sum of the cash that we pay to the suppliers and the cash that we owe to the suppliers. So to find the cash that we pay to the suppliers, we need to subtract from the purchases the amount that we owe. This is the increase in accounts payable, so we have minus 263, and so we get $11,900 cash paid to suppliers. Next, we can calculate the cash amount that is paid to the employees. The starting point is salary and wage expense, which can be obtained from the income statement. This is equal to $4,123. The salary and wage expense is a mixture of cash that we paid to the employees and cash that we still owe to the employees. So to find the cash that we paid, we need to remove from the salary and wage expense the cash that we owe. This is equal to the increase in the salary and wage payables, which is 10, and so we subtract from 4,123, 10, and we get cash paid to employees equal to $4,113. Let's now calculate cash paid for other operating expenses. The starting point is other operating expenses, which can be obtained from the income statement, and it is equal to $3,577. We also need the change in prepaid expenses and the change in accrued liabilities, both of which can be obtained from the two balance sheets. Other operating expenses are a mixture of cash and non-cash components, so we need to remove the non-cash component to arrive at the cash paid for other operating expenses. The change in accrued liabilities is positive and equal to 22, which means that part of the operating expenses we haven't paid in cash, but we owe it. So we need to subtract the increase in accrued liabilities equal to 22 from other operating expenses to arrive at the cash paid for other operating expenses. The asset prepaid expense went down by 23, which means that it is now recognized on the income statement as part of other operating expenses with the amount of 23. But there is no cash involved with this expense because it is a prepaid expense. So we need to subtract the decrease in prepaid expenses, 23, from other operating expenses. So we have 3,577 minus 23 minus 22, and this gives cash paid for other operating expenses equal to $3,532. To calculate cash paid for interest, the starting point is interest expense obtained from the income statement, and this is equal to $246. We also need interest payables obtained from the balance sheet. Interest payables went down by 12, and this suggests that we repaid some of the previous interest obligations that we had. So even if the interest expense of $246 is a mixture of cash and non-cash components, the fact that interest payables went down suggests that we paid for interest more than what is shown as interest expense. Specifically, we paid $246 plus the reduction in interest payables 12, and this gives $258 cash paid for interest. To calculate cash paid for income taxes, we start from income tax expense, which is obtained from the income statement, and it is equal to $1,139. Income taxes payables obtained from the two balance sheets went up by 5, so that means that part of the income tax expense we haven't paid in cash. So we are going to subtract the increase in income taxes payable, 5, from 1,139 to arrive at the cash paid for income taxes, which is equal to $1,134. We finished with the operating section of the cash flow statement, and we can move on to prepare the investing section of the cash flow statement under the direct method. To calculate cash paid for investing activities, we will need a couple of information, including the change in equipment between 2018 and 17, and also the change in accumulated depreciation between the 2 years. We are also going to need the information that is mentioned in the note at the bottom of the slide, that during 2018 Acme purchased new equipment for a total cost of $1,300. So notice that although the company bought an equipment at the cost of $1,300, the change in equipment between the 2 years, 18 and 17, is only $243. So it must be the case that Acme Corporation also sold equipment, which resulted in the net change in equipment of $243. We can add the dollar amount of the equipment that is purchased, which is equal to $1,300, to the beginning balance of the equipment that is on the balance sheet, $8,555, and subtract the ending balance of the equipment, $8,798. This gives us the dollar amount of equipment that is missing from the balance sheet, This is equal to $1,057, and this is the historical cost of the equipment that Acme Corporation sold. In the same way, we can also find the accumulated depreciation on the equipment that is sold. This is equal to the beginning balance of the accumulated depreciation obtained from the balance sheet, 2,891, plus the depreciation expense of the year that is on the income statement, 1,052, minus the ending balance of the accumulated depreciation from the balance sheet, 3,443. And this gives $500, which is the accumulated depreciation corresponding to the equipment that Acme Corporation sold. We are now ready to calculate the cash that is received from the sale of the equipment. This is equal to the historical cost of the equipment that is sold, $1,057, less the accumulated depreciation that corresponds to the equipment that is sold, which is calculated as $500. And we need to add to that the gain on the sale of the equipment that is obtained from the income statement, 205, and this gives us the total cash that we receive from this sale, $762. We finished with the investing section of the cash flow statement as well, and we are ready to move to the financing section of the cash flow statement under the direct method. To calculate cash generated from financing activities, we need to look at the long-term debt and common stock on Acme Corporation's balance sheet. We observe a reduction in long-term debt by $500 and a reduction in common stock as well by $600. This suggests that the company repaid part of its long-term debt and also it repurchased part of its common stock. To calculate the dividends paid by Acme Corporation, we can use the clean surplus relationship that connects beginning retained earnings with ending retained earnings, net income, and dividends. Specifically, the formula is as follows: beginning retained earnings plus net income minus dividends is equal to ending retained earnings. We have all the information that we need from the balance sheets and the income statement except for the dividends, so we can solve for dividends, which is equal to $1,120. The statement of cash flows under the direct method is now ready. To calculate the net cash flow from operating activities, we need to add up all the cash that come from operating activities. This is the cash received from customers, cash paid to suppliers, cash paid to employees, cash paid for other operating expenses, cash paid for interest, and cash paid for income tax. This gives a total net cash from operating activities equal to $2,606. To calculate the net cash flow from investing activities, we need to add up the cash received from sale of equipment and the cash paid for purchase of equipment. This gives a total of minus $538. So we have a cash outflow from investing activities. To calculate the net cash flow from financing activities, we need to add up the cash paid to repay long-term debt, the cash paid to repurchase common stock, and the cash paid for dividends. This gives a total of minus $2,220, so again we have a cash outflow from financing activities. The sum of cash flow from operating activities, investing activities, and financing activities is equal to the change in cash between the years 2018 and 17. This is the difference between 1,163 and 1,011, which gives a total change in cash equal to minus 152. To calculate operating cash flows using the indirect approach, we need to start from net income and do the necessary adjustments to remove any non-cash revenues and expenses. Net income is equal to 2,210 and it is obtained from the income statement. We add to that the non-cash depreciation expense, so we have plus 1,052. We then need to subtract the gain on the sale of equipment, so minus 205, and we do that so that we don't double count this cash amount because it is already part of the cash that is received from investing activities. We then have an increase in accounts receivables and an increase in inventories. And remember, when assets go up, we need to subtract that amount from the cash to balance the accounting equation. So we are going to subtract both of those increases from net income. For the same reason, we are going to add the reduction in prepaid expenses to net income, because prepaid expense is an asset and it is going down. So we are going to add the decrease in prepaid expenses. We have an increase in accounts payables and an increase in salary and wage payables. And when liabilities go up, we need to add that increase to the cash to balance the equation. So we are going to add to net income both of those increases. We have a reduction in interest payables, and we are going to subtract the reduction in that liability. Finally, we have an increase in income taxes payables and an increase in other accrued liabilities. As I mentioned before, we are adding the increases in liabilities, and in total we get a net cash from operating activities equal to 2,606, and this is exactly the same cash amount that we got with the direct approach. Everything else on the cash flow statement remains the same, because both the investing and the financing sections of the cash flow statement need to be prepared under the direct approach, and we have done this already in the previous slides. In this case study of Acme Corporation, we generated a cash flow statement using information only from an income statement and two balance sheets. So if we can infer a cash flow statement from an income statement and a balance sheet, then why do we need to report a cash flow statement? The articulation between balance sheet, income statement and cash flow statement breaks down when one of the following non-operating events takes place: when we have acquisitions, when we have foreign currency translations, when we have reclassifications or accounting changes between consecutive years. When one of these events takes place, then the changes in assets and liabilities obtained from balance sheets together with income statement amounts will no longer result in the cash amounts that we observe in a cash flow statement. And in these cases, we are going to need information about the exact cash payments and cash receipts to prepare a correct cash flow statement.